Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Wednesday, August the 14th. Hope you're doing well. Kids are back in school where I live in Florida here, so it's already started, and it was a long summer, so I'm glad the routine is back, which is important. I know other people across the country are probably not starting school until Labor Day and things like that, so enjoy the rest of your summer. Always lots going on in the housing industry. We'll talk about that shortly. Want to, again, extend thanks to people who have reached out to me with my Never Pay Retail program. I've got people who have signed up, which is great. Currently engaging more people, so if I haven't got back to you, I will. Just have had a very busy week trying to build out the program and do a lot of just normal business things as well, too. So if you'd like more information and receive a great discount on what we're trying to offer here and help create and give your input to the content of the program, please reach out to me. For those of you who have, I will be sending you stuff probably later today and tomorrow, connecting with you and showing you what the deal is, etc. And for those who would like to think about it, just again, reach out to me. I'll be happy to send you some information. So thank you very much. So again, just if you're new to the channel, by the way, we talk about everything housing market, real estate market, home prices, players in the marketplace, values, mortgages, news of the day of the week, things that are impacting the housing market, your values, your ability to purchase, things like that. So that's what we do. We take a no-holds-barred look at what's going on in the industry, and it's simple as that. So if you'd like to hear more about this, please subscribe. I'd certainly appreciate that. Thank you. So today we're going to talk about a few topics. My number one topic is that U.S. mortgage debt hits a record amount now, which is interesting. We'll talk about some cash-out refis, something called GlamperVans, which is interesting. The New York Fed take on the market, top 10 vacant home locations, how iBuyers may cost sellers a lot more than they realize, and a little op-ed on U.S. home prices and why they're at where they're at. So that's the scoop on that one here. So Wall Street Journal published a quick little report detailing the U.S. mortgage debt hits record, eclipsing the 2008 peak. So the mortgage balances that are out there hit a high of 9.294 trillion, and actually 9.406 trillion, which surpassed the previous high of 9.294 trillion, which is in the third quarter of 2008. So this past quarter, second quarter, mortgage balances were at a new all-time record high. So please keep that in mind. And the concern that's out there with some people, which I have to agree with, is the fact that obviously mortgage rates are low, so now people are able to jump on and get more activity with respect to mortgages. Well, refinancing has accounted for about half of the new mortgages in the second quarter, and that represents almost like a mini refinancing boom, because this time last year refinances were around 30%, and that's with higher rates. So clearly, when rates drop, people go, hey, I can refinance, whether it's just better rate and term, lower monthly payments. A lot of the issues there are the cash out refis, and that's the concern with people. So borrowers who refinanced in the second quarter and chose the option to cash out withdrew an estimated $17.5 billion equity out of their homes, according to Freddie Mac. Now, that was $2.1 billion higher than the second quarter of last year. It remains well below the pre-recession peak of $84 billion cashed out in the second quarter of 2006. So clearly it's not the same as it was back prior to the last housing crisis, but we're still showing trends that cash out refis are increasing. So they took out $17.5 billion. We've been seeing that rise over the past little while. So please keep that in mind. And clearly the whole idea with, when you do a cash out refi and you've now put yourself into, as a homeowner, into a higher risk element. So maybe you got a better rate and maybe you did a few cool things with your mortgage, but now you owe more and you're now susceptible to price decreases and market changes that could happen. And what you've done essentially is you've removed any of the wiggle room that you may have. Say you have to sell, but you've taken all your cash out, your 80% LTV. When you start doing your closing cost commissions when you sell, what do you have left after your mortgage payoff? May not be enough. And if the market shifts 5 or 10%, not in your favor, now you're stuck with, being underwater with your house. And funny enough, we have not seen a underwater study done. Typically that's done every quarter, so it may take longer to produce that, but I'm going to have to look at it. But I have not seen a recent, second quarter under home underwater home market study come out. So I would expect that should be happening anytime soon now. So, and this is an interesting saying. This is from a guy whose name is Wolf, and he runs the Wolf Report, Wolf Blitzer, and he mentioned that bad deals are made in good times. So obviously the economy is good or perceptually good. Housing values are strong apparently, even though we've seen some decreases. So lower interest rates, which makes it very attractive to somebody to pull money out, pull equity out of their home. And I have to say, going back to what the note said here about 84 billion being taken out in cash out refis in 2006, that was one of the main reasons why we had a housing crisis, because people just stripped equity out of their homes. And when we saw a shift in prices, they were underwater and were stuck. So please keep that in mind. All right, millennials considered living in GlamperVans instead of overpriced San Francisco apartments. So here's the cool thing, is that obviously the cost of living is very high in the San Francisco Bay Area, and especially for millennials looking for alternative housing options. So there's a company called GlamperVan, and it's based in San Francisco, and their deal is that they essentially convert commercial vans into full-blown glamping vans with a bed, kitchen, refrigerator, table, rooftop, deck, maybe a shower, things like that. So the whole idea that this was a glorified, camping sort of tool, and it's kind of fun, but I guess they're finding that more and more, I guess they're being influenced by broke millennials who can't afford overpriced homes nor pay inflated rents in the Bay Area. So they're seeing a surge with respect to people going, I'll take one of those, and that's where they're going to live. And the cool thing about it, it's not like it's a big, huge RV. It's a commercial van, so it's compact compared to a huge RV. And if you play your cards right, you can drive place to place to place and stay overnight and kind of always be on the move. So you're avoiding some of the legal issues or ticketing that goes along with that. And the whole idea is you're saving money. You're saving money on not paying high rent. You're saving money by not overspending on a mortgage. The big issue is saving commute time. So obviously, the farther you drive out from the city center where you work, prices should be decreasing away from the metro. So it's almost like a direct correlation. The farther out you are, the cheaper the price, but the longer the commute time and the hassles go along with that. So people are saying, hey, why do I have to deal with this? Why don't I do this glamping thing? So I think it's really cool. So again, they were initially designed for the millennial weekend glamping trips, but have now become full-time residences for many of them. And new rules in San Francisco make it illegal for people to sleep in their cars overnight, but that isn't stopping thousands of people from living in RVs and vans. So there you go. I mean, obviously, we know that San Francisco has a huge homeless population, issues that go along with that, and now we see people shifting to the GlamperVan lifestyle. Very interesting. All right, the New York Fed, housing starts and permits are anemic. So the New York Fed, Federal Reserve Bank of New York, the other day basically called out the housing starts and permit activity as being anemic in the report on to the economy, called out home sales to be lackluster, and basically additionally Redfin reported that the supply of new homes fell 1% in Q2. It's the largest decline in 6 years, and when there's a shift in the market, new construction is always one of the first categories to take a hit, and then things follow. So it's interesting that even like the Fed is saying, hey, what's going on here? What's going on in the marketplace? We're not seeing activity here. So builders are not going to speculate. They're not going to develop land and pull permits and build spec homes for you to jump in. It's not going to work for them. So they're going to wait until they have buyers, and they're going to work, from that perspective. There are no more spec homes from what this tells me here. So again, the New York Fed stating that our market for the new housing sector is anemic. I'd have to agree with that. All right, top 10 vacant locations. These are top metros with the highest vacancy rates. Now, interesting thing about this, and reason this was a study that was done back in March, but it's being referenced in a lot of news articles that are coming out these days. So I just wanted to touch base on this now. With respect to vacant properties or vacancy rates, they're not necessarily all abandoned and disheveled, distressed properties. I want to be clear on that. But vacant properties could be vacation homes, seasonal homes, second homes. They could be zombie foreclosures and people that are in transition that have walked away from their homes facing foreclosure or been foreclosed on. There could be that going, and there could be probate. They could be people have passed away and their relatives haven't secured the home and things like that. So, and again, it could be renting homes that are for rental or lease that are in between tenants and leasees. So there's a lot of factors in play here, but the top 10 metros that have the highest vacancy rates in the country are, believe it or not, Miami, Orlando, and Tampa. That's your top 3, so they're all in Florida. Las Vegas, Birmingham, Alabama, Jacksonville, Florida, New Orleans, Riverside, California, Phoenix, Arizona, and Memphis, Tennessee. So there you go. Now a lot of these locations are investor opportunity locations. I realize that, but just goes to show that there's a lot going on in real estate, and there's some of these vacant homes are either potential residences for renters if they're not leased up at this point in time. They're potential deals for investors or to buy and utilize. They're potential deals for owner occupants if they can get their hands on them to live in. So it's interesting that you see how much is out there still, and this is still making the news. But again, Miami, Orlando, Tampa, the top 3, Jacksonville at number 6. So 4 of 10 are in Florida, which is not surprising. Again, the demographic of where we are in Florida, there is second homes. There are snowbirds and seasonal people, and sometimes snowbirds, when they're not using their home, they'll do short-term rentals when they're in the off season, when they're back up north. So it just depends on how you look at it. But interesting to note, though, that we're seeing the fact that now there's more scrutiny on, well, why is that home vacant, and is that an opportunity for me, or can we convert that into an opportunity? Interesting. Okay, iBuyers. We got the iBuyers, so we all know about the iBuyers, right? You got Zillow and Redfin in the game. You got Open Door and Knock and all these places. So there was a little bit of a study done by a group called Collateral Analytics, and it said that the market for iBuyers is exploding and growing about 25% every year for the last 4 years. And of course, I mentioned you got the Open Doors, OfferPad, Knock, all these groups that are basically funded, and they're trying to buy your home quickly. But I guess the paper was looking at the math behind the iBuying model, estimating that sellers end up paying between 13 to 15% more than when they work with an iBuyer versus working with traditional real estate agents. So the point, though, is that the iBuyers, if they're working with you, you as a homeowner, you're paying for a convenience price, right? So you've got an offer, you have a firm closing date, maybe you don't have to do anything with the property, curb appeal, fix repairs, whatever. They're buying your house as is, but I guess in the fee structure and whatever they're talking about, this could be part of what you get or what you don't get. So the lower offer price may actually factor in this paying extra 13 to 15%. But the whole point, though, is that you're not making as much money as you would be selling by traditional means. The offset of that is quick sale, guaranteed sale. The number's been discussed. You can close quickly, or as they say, you leave when you want, out you go. And there's no additional issues that go along with that. They homes change hands, you split, they pay you, you go on your merry way, which is interesting. So I think we'll see more of this transpiring, more of this information will come out. I'm certain that real estate companies, brokerage firms, NAR, whatever, will probably be looking at this as well too, because they're going to have a response to this growing market segment saying, hey, don't forget working with us realtors here. We can provide you lots of services. We can help save you money. We can help earn you more money on your home, et cetera, et cetera. But again, it's all about ease, right? It's about going on that handheld or that iPad, whatever you have, typing in some things, communicating, virtually email or application based, getting some numbers, deciding whether you want to move forward. So the convenience factor there, the less hassle of going through a listing process, of having your real estate agent saying, well, you got to clean up and you got to fix these things, and we need to stage the house, and we need to do some curb appeal, because if you want to get the maximum offer, you need to do these things to attract buyers. And again, the process, listing the house, open houses. By the time it gets shown and you go into contract, you've got to wait for the mortgage on a new buyer to go through. So all these things are factoring into someone who's a homeowner who's saying, I just want to sell my home and get out of here. So maybe as I said, maybe the convenience factor is outweighing all those other issues. Only time will tell to see how this plays out. So I do find that interesting, by the way. Okay, last component here is an op-ed about here's the real reason why U.S. home prices haven't been smashed yet. And the author of this is a guy called Keith Juro. You can find this on Market Watch. I'll post a link to this in the comment or the About Us section of the video here. Now, he has been a pretty reasonable writer of articles about the housing bubble. He's got a bunch of articles about why we're going to have future housing bubbles and future housing issues with respect to mortgages and stuff like that. So he's fairly well, and he's very well informed, and I personally like to listen to him because I think he's spot on with a lot of stuff here. But his kind of point is, well, what's going to happen in the future? Because when you look at the situation we're kind of coming into is that there's a surge in single family rentals. So we're seeing and we've talked about this before, we've seen the investor market pick up more and more properties that aren't being used for flips, they're being used for single family rental. That's a new asset class, it's a very stable asset class, so there's a lot of people who are looking to do this. Whether you're a real estate investment trust, hedge fund, large investor, or even just we call it mom and pop weekend warrior investors, people are looking to get into this game. It's cash flow, retail, the whole bit. All right, so you can get you want that to happen. So according to the U.S. Census Bureau, the number of single-family rental units has soared since the last housing bust began. The Bureau estimated that 3.6 million single-family homes for rent have been added, bringing the total number of nationwide to more than 15 million single-family homes that are being used for rent. And that's basically when we're looking at 22 of the 30 largest markets in the U.S., cities had larger percentage gains of single-family rentals than multifamily units over the past decade. So this is where people want to own these and put you in as a renter, simple as that. The investment surge over the past 6 years is largely driven by the purchase and rent strategy. So even though there's flipping and fix and flip opportunities, the driving strategy here is purchase and rent. So that's, I guess his point is it's propping up the numbers because I can tell you that, there are hedge funds that can beat, normal smaller investors at the auction. They can pay a little bit more. Maybe, they're not looking to turn a revenue or a profit in 3 to 6 months. They want to hold these for 7 to 10 years, etc. So their economics are different. They're not going to overpay, but they can pay a little more than the average person because their numbers may play out differently over time. So according to these numbers, more than 1/3 of all home purchases in 2019 have been made by investors. So 33% of the homes purchased so far this year have been investor purchases. And yet even with this increase, the investor purchasing, the volume of home purchases is in most metros is declining. So even though we're seeing less and less sales, but the investor market's increasing, so that we're being kind of crunched there. So retail buyers are buying less just naturally in these large markets. And his comment was, had it not been for the aggressive buying by investors in the past 2.5 years, home prices would have already slumped in a lot of these metros. If you don't find this suggestion plausible, remember that it was the pullback by speculators, investors in 2006, and their dumping of properties onto the market that started the housing collapse. So that's kind of the situation you're at here. And the important question going forward is whether purchasing by investors can remain active enough to support current home prices. So, prior to that, we had, what was propping our home prices up the past couple of years was foreign buyers, right? So in a lot of the large metro locations, you had a lot of offshore money from Europe, from Asia, from Canada coming into the U.S. here, paying cash, or at least, are taking good mortgages, buying properties, and typically for buy and hold, or for maybe some other issues, but that's kind of the main thing: buy and hold, or to gain residency and other things that will happen in a couple years from now when you buy the house. So that's been a very solid game plan. That's also propped the marketplace up. But when you remove that, because that has decreased significantly over the past year, we're seeing this very, very quiet investor buying, just keeps on plugging away, and they're buying at the auction. They're buying off the MLS. They're buying via wholesalers. We also know that a lot of these investor buyers are talking to the home builders like Lennar, like D.R. Horton, like Toll Brothers, and they're going, hey, how about we finance this and we'll buy all these homes in your community, or a lot of these homes in the community. They're buying brand new homes with the full purpose of renting them out to the rental marketplace. So this, you can see where this shift is going. So how this affects the market, does it prop it up? I'm sure it does. Now, are they going to dump these homes in the near while? I think the game plan is for people, for the investors, the whole idea is you're going to hold on to these homes for 5, 7, 10 years, etc. Get your cash flow, ride your appreciation, whatever. So I think we're at another interesting time here, as every so often when you pull back what's going on, you can see that something is propping up the marketplace, and which kind of goes back to my, I don't want to call it a theory. Well, I'm not going to call it a certain word, but basically, when it comes down to where our market is today, it's not because we had this great economic boom since 2012 that suddenly all of our prices have recovered 50% and life is good. Sure, there's been some economic increases that have helped the market move forward, but the main reason is the stranglehold on the inventory, the lack of inventory, or the stranglehold that certain groups are holding inventory back, or trading inventory amongst themselves and not having that inventory hit the open market, not having that inventory be allowed to have retail buyers purchase or bid on it, and therefore when there's it's supply and demand. With less supply, you're going to have greater demand, which means prices will push, and sellers will know, homeowners will know that they can increase their price points and get what they can from buyers who need to live someplace. So when it comes down to it, that really is the main reason. It's a video that I'm going to do in the future, just trying to figure the right timing on this, but it does make an impact. So please be aware that we're always going to have this in the sort of the background, these investors who are buying properties. And this is not, again, my point though is that they're buying stuff that the average person's not going to get their hands on. Have the contacts, don't have all the cash to purchase that inventory, don't have the big pockets with hundreds of millions of dollars of cash to trade large pools of assets with other banks, lenders, non-banks, whatever. So the market is kind of being choked for the retail buyer, and we're having to pay the price for that. So that's kind of my opinion. So the op-ed on this was reasonable, but it just goes to show that you can see that the single-family rental as an asset class is growing, and more people are looking to it. And I for me, that's something that I certainly agree with that concept. There's a great opportunity there. The problem is, where do you find them? And that's the key, and that's what I like to do, is show people how that is done. So anyway, everybody, thank you very much for watching the video. Thanks for the views. Thank you for your comments. Please like the video. It helps me grow. And if you're not a subscriber, again, if you could please jump on, that would really help me grow the channel and get more videos out there. So once again, if you haven't reached out to me about my Never Pay Retail beta product, please do so. I'm starting to roll it out. Again, I want to extend a thank you to those who have jumped on already. I've gotten some feedback now on what certain people are looking for as far as information. It's quite diverse, it's quite vast, so it's going to give me, I've got framework available and I've got a lot of information to share, but it's going to help me sort of pinpoint, instead of just talking generically, maybe be a little more finite and specific in some of the things we'll talk about in the training. So I do appreciate that. If you're not engaged with that, send me an email and I'll send you some information and we can get going from there. So again, thank you everybody, and hopefully we can get a video out later on this week, and we'll talk to you soon.